The problem with looking at the past is everybody always thinks they're smarter than they actually were, or the you have this, what do they call it? The bias, recency bias, I think
Yeah.
is what it's
Well,
called.
April is actually a really interesting example of this. Like, if you go back and look at April, things were pretty normal at the beginning. Then all this tariff stuff came out and it went down. And then April ended up pretty much exactly the same
It
place
was
that.
like down, up, flat.
Yeah. And that's why you can't react to short term changes. Is, if we
Yeah.
had sold, like, when do you get back in? When is it the bottom? Like, it's too hard to time it.
Welcome to Finance for Physicians, the show where we help physicians like you use money as a tool to live a great life. I'm your host, Daniel Wren, and I've spent the last decade advising physicians on their personal finances, with the mission to help them understand that taking control of their finances now means creating a future where they can practice medicine where, when, and how long they want to.
What's going on, Jen?
Oh, hi. Long time no talk.
We're back again. 2 seconds later, we've just been recording a few shows today and have catching up on some fun news stories. We're not going to get into that today. If you've
Go
listened
back
to
to the
our
rent versus buy podcast and you can.
yeah, if you want to hear about what we're talking, yeah, check the Rent versus Buy podcast. It's a big tangent, but anyway, um, today we're going to be talking about some of the hot questions we're getting. Some of the most popular questions we're getting lately. I guess a couple of these are like pretty standard. We always tend to hear them, um, but the first two that for sure are, I guess, market economy, politics dependent or
All the
driven.
good stuff.
So anyway, you want to throw out the first question or you want me to?
I don't remember what it was, so.
Oh, then I'll handle it.
Okay.
And it's the one I proposed. So, and it's because I've gotten this question at minimum 1,000 times, literally. So, and the question is, how will the
Yeah.
tariffs affect my investments?
Yeah.
And the answer, Jen gave the answer already. And what's the answer?
I don't know.
Uh, and I tell people that a lot of times they come up at like social stuff. They're like, "Oh, what do you think about the tariffs and blah blah, blah. And what should I do?" And I'm like, "I don't know." And they're like, "What?"
What do you mean you don't know?
A little disappointing, but we'll give you a little more context. That is the accurate way to look at it. The problem is we really don't know. Short term. There's too many things that have yet to play out. Like, I guess you can look. There's two different sides. This is a political thing too. So
I'll
I'll try to
try to
like
stay out of that part.
I'll try to like be in the middle. But um, there's one side of the uh, political sphere that would argue that it's a negotiation tactic and it's going to allow some of the bigger goals to be accomplished faster and that it's not going to it doesn't actually affect prices or inflation, um, like a lot of the economists say. That's one side of the equation. The other side of the equation is that it for sure drives inflation. It hurts very quickly. Prices obviously go up because the tariffs have to be paid for, and it gets paid for by the consumer. And that it's not a negotiation tactic; it's a way to raise taxes indirectly. Those are the two arguments. So the problem is we don't know which one actually is true. We don't even know how they're gonna the overall strategy. You know how our current president is about changing course. He's kind of a little bit all over the place. I think both sides would agree with that. And so you just don't know. You don't even know what the strategy is exactly. And we could find economists to argue both sides. So it's like a lot of these big things. You don't know early on how it's actually going to play out.
Yeah. Is
But
this real?
people,
Is it going to stick? Is this a bluff? We don't know.
is it a bluff? Is it actually a negotiation tool? Like what? So we don't even know what we're dealing with, first of all. So, but then people will be like, well, when it happened the other time, and they'll be like, back when it happened in 2016 with the weather, whatever thing that happened, um, we kind of knew then. And I remember thinking I needed to change my investments then, and I didn't just because but that's the problem with looking at the past is everybody always thinks they're smarter than they actually were, or the, you have this, what do they call it? The bias, recency bias, I think
Yeah.
is what it's
Well,
called.
April is actually a really interesting example of this. Like if you go back and look at April, things were pretty normal at the beginning. Then all this tariff stuff came out and it went down. And then April ended up pretty much exactly the same place.
It was like down, up, flat.
Yeah. And that's why you can't react to short-term changes is, if we
Yeah.
had sold, like, when do you get back in? When is it the bond? Like, it's too hard to time it.
Right. And if I look at the volume of all the questions I've gotten on this particular question, it's like these tariffs, I got to get out, I got to do something different. Had all those, the time the questions were at the highest, the market was starting to fall
Mhm.
and, getting further down. And so if people, maybe they got lucky. I don't know. Not many people were asking me that question before it started to fall. It was
Yeah.
like when they started to see a little or hear about it more is when the questions really ramped up. And so I would bet that a lot of people that actually acted on that would have made a change after it had gone down potentially substantially. And then right now, post all that, they would be like paralyzed about what they do next.
Yeah, because
Because,
now they want to get back in and it's back up.
well, it would have bounced back up so fast that they would have been like, whoa, I didn't expect that exactly. But then they would have been like, oh, it's a minor blip. It's going to go back down. It's just got to kick in. And so now you're in this bad spot of like,
Analysis paralysis spiral of
there's never a good time to get back in. And it's a tough spot. So, I've come across people many times that are holding cash from like 2007 because they did something like that. And they're like, well, just never
I'm
was.
just waiting for the right time.
I'm like, well, okay.
Well, and I think those are always good opportunities to just throw some education in there for people. Like there's always a tariff thing. If it's not tariffs, it's COVID. If it's not COVID, it's the financial. If it's not that,
Yeah.
there's always something to be
Right.
scared. And fear sells. Like it's going to be in them. They want to scare you. Like that's their.
And the other thing is it's always unique. Like they're always the smart news people were like, say the tariffs are blowing everything up, and this time is different than any time ever before.
It'll never be the same.
This is a unique time, or they use and that's actually partly true. It's the whatever flavor of it is definitely unique, but like the fact of this kind of thing happening is completely not unique. It happens all the time. There's always a new thing.
To scare you, because if they're like, hey, everything's going to be fine, you're going to stop watching the news. Like
that's very boring.
Yeah, they have to, get your interest up.
Right. Okay. Well, that was a long-winded way to say we have no idea.
We don't know.
Which is why you should not do anything. I mean, like, talk to your financial advisor for specific advice.
Call us, email us, we'll talk to you.
But you really, at the end of the day, we don't know.
Let's take a quick break to talk about our firm, Ren Financial Planning. The goal of our podcast is to empower you to make better financial decisions. But sometimes the best financial decision you can make is to work with someone who understands your financial goals and has the expertise to keep you on track to reach them. That's where Ren Financial Planning comes in. We are a full-service financial planning firm that works with over 400 physicians and their families across the country. We charge a transparent monthly flat fee for our services and offer virtual meetings you can take from anywhere. Best of all, you'll get to work with a team that specializes in working with physician families. So whether you're starting out and wondering how you'll balance your student loan payments and saving for a home, or you are an established physician trying to figure out how to pay for your kids' college and how much you need to save to reach financial freedom, we can help. I'll put a link in the show notes to schedule a no obligation meeting with one of our certified financial planners. Ren Financial Planning, LLC is a registered investment advisor. For more information about our firm, please visit renfinancial.com. That's WRENNE financial.com.
next question along the same lines. And I think these are kind of interrelated. And this is why we've been getting this question, I think, more often is secondary to that first point we brought up was, should I stop investing regularly due to all this uncertainty? So that's
Yeah.
kind of like a baby step in doing something.
Yeah. There's this chart that I'm picturing in my mind right now it's kind of like uh what's the word for that symbol? Like a approximately symbol or whatever. Like if you're gonna say
Uh,
something, what is
Sideways
that?
S.
Yeah, I don't know what that's called. But there's a chart that looks like that. And it's kind of it's a representation of investing behavior. So if you can picture the sideways S, right here, when the market's high, everyone's super excited about investing, and then it goes down to the other side of the S, and then no one wants to invest down here. Really, it's the opposite. You should be the most excited to invest when the market's down and scared to invest when it's up, but it's people's mindset is actually different. Um, uh,
Yeah. I found a
most,
version of it online. I just Googled real quick. It's like when it's going up, it's like hopeful, excited,
yeah,
ecstatic, and then it's
yeah,
like
point of
nervous as
maximum
it
risk.
starts to go down. It's nervous, desperate, panic, and panic is at the very bottom. And
Yeah,
then it starts to go back up again, and it's like doubting, hopeful.
yeah.
So it's basically like reverse psychology is like,
And it repeats itself over and over and over. And because we can't point to the highs and the lows, write it out. Like we can't pick the highs and the lows. You know, that also makes me think of that. There was a study done on people whose portfolios had performed the best over like a 30-year time period or something. And it
yeah.
was people who forgot they had 401ks because they just didn't touch them.
Yeah.
It was like the classic buy hold.
Yeah. I guess that's not really surprising. It's the ones that are tinkering with it. It's
Yes,
danger
exactly.
zone. So I think the easy answer to if all that you're asking is should I stop regularly investing due to market uncertainty, if that's the only thing that you're considering and everything else has stayed the same from before, like as in you're still in a good position to be able to invest and it makes a lot of sense in your planning, then definitely no. Like that's it's not because essentially that's trying to time the market basically. Essentially that is a smaller version of timing the market. Like the aggressive timing the market would be like, I'm getting out of the market. I'm changing all my investments due to all this tariff uncertainty, whatever. But stopping investing your regular monthly or however often you invest contributions is like it's like dipping your toe in the market timing world.
Well, and I
And
think the key to that is to back up and say you should have a plan that has you investing in a way that accounts for these things. Like where you should
right,
be investing in a way that um, isn't a short-term dip isn't going to change the trajectory of your plan.
right. And a good example of that, I'm going to go on a little tangent here. Rein me in if you need to, Jen. But
Okay.
international versus US. So we kind of like preach, advocate the uh, passive approach, which the ultimate passive is like you're passive, you're basically investing how the world market invests or how the world market is capitalized. So the size of the world market, you're spreading it out all over the place. And so the ultimate diversification is to have, lots of different stocks all over the world. And so right now, for example, where that comes into play is when certain sectors or certain even regions have trouble. So the tariffs are a good example. I think some of the like over that period of time when people got freaked out about it, the U.S. economy or the U.S. stocks really got hit, especially small U.S. stocks. They went down a lot versus international, not near as much. Um, and then in particular, I think certain industries went down even further as a result of that. So, um, on the other hand, so comparing that to international has actually done pretty well. Even now, I think to this day, even though stuff's recovered in the US, I think international is looking really good relative to the US over the at least year to date or whatever time period. And That's it. I don't know. Like we were saying, we don't know what's going to play out. Like we don't know what the economy's actually going to look like. A lot of this is hype, but it does kind of make sense that the international stocks would be doing better over a period of time where there's a ton of uncertainty in the US. And
Sure.
the key, though, is you own both. And so you're diversified to the point where these volatile time periods are less of an issue for you.
Yeah. Yeah. Well, it's like, I mean, you can, I don't know, I'm picturing that quilt, that asset class quilt in my head
Yeah.
right now where
You're very
every,
visual today.
I am. It's
Yeah.
because I got this whole boat thing in my head. I'm like,
If you want to see the quilt, Google what do you Google asset allocation quilt or investment quilt. It's
yeah.
pretty cool visual of what I was just talking about.
Each asset class has its time in the sun, but we don't know when that's going to be. Like, there's no
Right.
pattern to it. Like, you look at that quilt, it's
All
very
over.
irregular. So it's rather than trying to be like, okay, I bet in 2 years from now it's going to be small caps time in the sun. You say, I'm just going to hold everything in relation to this total market, and then I don't have to play the timing game.
Right. And then the other thing about the investing regularly, that's big time psychologically, habit form wise, is very good to have developed that habit. And it's kind of hard sometimes, especially certain people, everybody's different. Some people struggle with it more than others, but um, it's like going to the gym. Like if you're or eating healthy, if you're in the habit of going to the gym, it's like autopilot. You don't even think about it. In fact, you get a little concerned if you're not going because you're like, I got to do the thing. So, but if you're not going to the gym at all, the getting in the habit of it is very difficult. So the same thing, it's similar, like investing regularly. People that invest regularly, like on autopilot, they don't think about it. It's just like automatic.
Yeah,
And if they turn it off, then they have to go through this whole psychological exercise of like getting back in the habit and convincing themselves it makes sense. And so that's another downside of turning it off is you have to,
habit building.
yeah. So ideally, you just keep the thing going and not worry about these hyped up short term. I guess it could be long term. We don't know. But
And
um,
always talk to your advisor.
so last question. Speaking of diversification, we did talk a little bit about diversification. One of the questions that comes up a lot, I'm sure you've gotten this question, Jen, right?
Yep, a lot. It's a tough
Real
one.
estate so is real estate, well, I think the way it comes up normally is like, I'm going to invest in real estate.
I don't want all my eggs in the market. I don't want all of
Right.
my wealth building to be in the market. I want to diversify.
Right. I'd like to diversify. I feel like I got all my eggs in the market basket. And so I'd like to diversify into real estate. Typically, what people are talking about there is real estate, as in either buying a rental property or a syndication or a deal or whatever locally usually or sometimes not locally, but that's generally what I think what people are talking about. So I think the question, what I would be asking instead of how we positioned it, I would pose the question to Jen: is that type of real estate investment good for diversification?
Typically, I would say no. Not just for the idea of um, like, is this going to hedge against what my portfolio is doing? Like, is it going to act inversely or um, anything to that? But also just the um, amount of money that you typically have to put into a rental property
Yeah,
um, relative to how much you have invested. Usually you're concentrating a risk quite a bit.
right. So in reality, it's the opposite of diversification. It's concentration. So um, the other thing too is you probably own real estate already, and you may or may not realize it. So
That's what that most likely do.
if you're with us, or even any big most 401ks have real estate funds. And even if you don't have a real estate fund, if you own the Vanguard total stock market, a little sliver of the pie is real estate. So, but if you own like the Vanguard real estate index, for example, it's investing in all the kinds of different real estate all over the country, every different flavor of the real estate market you can think of, it's investing in, and it's spread out everywhere. So that's like the ultimate of diversification. And so if that's actually the number one focus is diversification, then just buy some Vanguard total stock market and it's ultra diversified.
Yeah.
Okay. Well, in summary, our answers are I don't know, no, and no.
Yes. I don't know. No, and definitely no.
Definitely no. So don't worry about the tariffs yet. Let's see how it plays out. Definitely don't go changing your investments because of that. Stay the course with your automatic investments unless something's changed in your circumstances. That's different.
And please let us know.
Yes, if you're working with us, let us know. Even if you're not working with us, we're happy to answer questions and that kind of thing. We're not going to give specific advice because you should consult I'm throwing out disclaimers. Consult your tax and financial advisors for advice specific to your circumstances. And then real estate is typically in the context we raise not good for diversification. There's other good reasons. I don't want to poo-poo on real estate too much.
Yeah.
There are other good reasons to do it.
Just not.
Yeah. Diversification is not one.
Yeah.
So,
yeah.
All right. We almost got done on time. We said we were going to do 20 minutes. So we're pretty close. So we can call it a wrap at that. Jen, I've enjoyed going through these questions today, and thank you for your input.
You're welcome.
No guests or clients appearing on the podcast received any form of compensation for their appearance and obtained no other benefit from us. It should not be assumed that every client has had the same experience.